Let me show you what happens every time the borrowing gets this heavy. These crazy leverage bubbles have blown up 6 times in modern history: 1929, 1987, 1998, 2000, 2007, and 2021. But today, I want to focus on the 3 key ones: 1929 before the Great Depression, 2000 before the dot-com bubble, and 2007 just before the Great Financial Crisis. Because understanding these will help us understand what our portfolio is faced with today so we can be prepared. 1929 first. So in the 1920s, you could buy stock with 10-to-1 leverage. So you put down $10 and you control a $100 position size. Shit was crazy back then. And of course, ordinary people did this in enormous numbers. Clerks, teachers, taxi drivers, all buying stocks with money that they didn't have because stocks were going up only. By October of 1929, brokers had lent out over $8.5 billion against stocks. That was more than all the physical cash circulating in America at the time. $8.5 billion in margin debt in 1929 is absolutely bonkers. Then the market wobbled. It started on the first day. The margin calls began, just a trickle at first. People said, it'll be fine, it's just a blip. And for a couple of days, it looked like they were right. But then Monday came and it got even worse. But people still said, no, don't worry, it's going to recover. Then Tuesday came. And that is still the most famous single day in stock market history. Black Tuesday. Hundreds of thousands of people were wiped out in a single day. And not only did they lose all of their own money, they ended up owing their broker money too. Remember that 35% buffer we talked about, the margin requirement? That's there so the broker has room to sell you out before you lose their money. But if the market crashes too fast, they might not be able to close you out in time. Then you're not just losing your money, you're losing their money, and they come after you for it. It's rare these days because computers close positions immediately, but it's still in every broker's contract that you sign. And in 1929, there were no computers. And it also can happen today. Just to be clear, you can end up owing the broker money if the market crashes fast enough. Anyway, so the market fell 89% in 1929. From its peak, it took 25 years to recover, which is absolutely insane. The next big one was the year 2000. In the year running up to March of 2000, margin debt nearly doubled from 150 billion to 280 billion. Keep in mind that we're at 1.53 trillion today. And while inflation accounts for some of that, today's bubble is still much bigger. But yeah, in March of the year 2000, margin debt peaked at the same time as the market and everything collapsed together. Now, everyone remembers the dot-com bubble as a story about silly internet companies, but underneath it was the same forced selling as 1929. A margin cascade that turned what could have been a tiny little correction into a major collapse. The NASDAQ went on to lose 78% and it took 15 years to recover. Now, let's quickly talk about 2007. Margin debt surged in 2006, topped out at 381 billion in July of 2007, 3 months before the S&P 500 topped and then crashed. The S&P fell 57% and took just under 5 years to recover from its bottom. There's also 2021, which led to 2022's bear market, but I've explained enough of these now. You get the picture. Quick thing before you go, I've written a free guide called How to Retire Before 2036. It's a full 10-year plan for anyone starting late. Get out of debt, invest properly, retire on time. Free download, link in the description.